In this class, we'll see some of the accounting standards and we'll start with employee benefits under AS number 15. AS number 15. Right. Liabilities based accounting standards. These are classified as liabilities based accounting standards, employee benefits. This employee benefits is applicable wherever the payment to the employee is required as per the legal purpose or otherwise by the employer voluntarily. Statutory provident fund and national pension scheme contribution, ESA contribution, all these things are legal requirement. Sometimes employer can voluntarily contribute out of his own interest, leave cash, whatever it may be, like PF, gratuity, leave encashment, retirement benefit, or any other welfare scheme or other benefits. For all these things, it will be applicable. Either the employee benefits to be provided as per the legal requirement or otherwise by employer voluntarily. For that, this AS number 15 is applicable. The examples for these employee benefits are listed here. In case of ad hoc payment, employee benefits under AS number 15 not be applicable. Ad hoc, voluntarily, as and now when the employer feels satisfied, he will decide to give the ex gratia payment, like a gracious gratuity payment at the time of retirement. If he is having good relationship with some employee, he will give gratuity. For somebody else, he will give lesser, and somebody else he will not give anything and terminates abruptly. That's what about the discretion of the management. May be possible in case of unorganized sector. Okay, run by sole owner, what he feels and he will do. So that will be called ad hoc. For that, AS number 15 not applicable. Now, what are the plans we have for the employees' benefit? One is defined contribution plan, another one is defined benefit plans. We have two models, defined contribution plan, another one is defined benefit plans. Okay, under defined contribution plan, employer contributes and employee also contributes for the retirement benefit. At the time of retirement, the employee can withdraw from that retirement benefits, the amount available there. So what we do in income tax, PF 12% deposited by the employer, similar amount is collected from employee and so deposited. While withdrawing, what is the amount he can withdraw? The amount available there is withdrawable along with the interest on that. So retirement benefits as per the agreed contribution at agreed rate 12%. Good example being PF. Usually the employer pays the contribution for the employee's PF account, no, debited to the P&L account. And if anything, still we have excess, if any, also be considered as defined contribution plan. Okay, other than these two, retirement benefits, contribution like PF and excess, if any, all these things are coming under defined contribution plan. I contribute 12%, 14%. 12% is a legal requirement, but the employer offers 14%. Another 2% can also be considered as expenses. Defined benefit plans. Next, we'll deal with the defined benefit plans. Defined benefit plans is nothing but employer offers you on retirement, I will give so many facilities. After the retirement also, employee can get the medical treatment with the employer's hospital, or employer will have the options to ask him to reimburse any expenses he incurs for the medical expenses. Okay, now the question is, do you know which employee demands how much is for their medical expenses? Hundreds of employees. Few employees may meet with the huge medical expenses bill and the employer has to pay. Some employee will not spend even single penny for the medical purposes, he will not claim anything. Now the problem is, will the management know how much has to be payable? Definitely not so. This is what about the benefit is defined, but the value I spend for that is not calculated. So automatically it can be calculated based on only probability model. Okay, probability based. Amount determined with reference to the employee's earning and year of experience. If you have 10 years of experience, or if your earning is being 2 lakhs as you are being in the senior category, you will be eligible for these benefit. Free transport, free medical, free education for your child. Okay, what's the cost? I'm not sure. And employer is responsible for specified benefits, and employer also sometimes responsible for some sort of specified benefit. But the problem is uncertain and subject to estimation of future condition and events beyond the condition. He is not able to find out what is the real amount payable for that. So for this, defined benefit plans, usually we have to depend on actuarial valuation. That's why this AS 15 earlier, when it was introduced very first time, all the concepts were there in the syllabus. Later on, those areas requires the probability calculations are all now outside the examination purpose. So you don't need to worry about this concept. Is that clear? Now, how can you account it? Accounting treatment. Now, you may have a separate fund, no separate fund scheme, fund through insurer. These are the three schemes you have. Now, what do you do? Employer, employee. For the service rendered by employer offers him salary. Apart from that, employer deposits PF amount for his name. Also, he collects and deposits the employee's contribution also with the PF amount. Clear? This is as per the recognized provident fund. Employer maintains all this amount with the PF account. Clear? But the PF requirement is applicable where your employee's number being more than 20. 20 or more than 20, automatically PF Act will be applicable. Then you have to legally you have to maintain as per the recognized provident fund. But employer having, only 5 employees in the organization. Now PF is not required, so he is not going to pay the amount with the recognized provident fund account. Rather than he can have his own separate fund when he retires and the amount is released from here. Or employer 1, employer 2, employer 3, all the employers put together will create a common fund and they will deposit. Anything happens to any of the employees, amount is released from the fund. This is the common fund. Common fund created by a small team of employees, so employers. Another one is, rather than with the recognized mode, rather than separately as they wish they can pay, or rather than a team of employers creates a fund for settling the requirement of various employees on need. So these are the three cases we have. Another one is employer simply pays the premium to the LIC company. Now it's the LIC company's role to pay to the employee. What is the benefit for the LIC company? Premium is paid. The employee survives for the entire life. On retirement, he will get the, but halfway through 5th year or 6th year, if dies, then he gets his family will get a compensation, claim, full value. So it seems to be much better way. So these are the options. All these options are there. One is no separate fund like this one or this one. So they have their own fund can be used for at the time of settlement. Actuarial provision should be actuarial base for accruing liability. How much I supposed to pay for the retiring employees? I'm not sure. How many employees I have? How many employees are going to retire? All these things are calculated based on the probability model. The probability model will be used and the liabilities is calculated by the experts in that field called as actuarial science. That actuarial scientist will give the guidance how much your liability is there and what is the liability you have in this period. So earlier you have 10 lakhs to be payable. In this year it rises to 11 lakhs. It means 1 lakh additional liability arises by another 1 lakh. That will be debited to the P&L. And what about the payment for the retiring employees? You can pay out of this provision. This is first case. Separate fund. You can have your own fund or through trust PF account, recognized provident fund account. Actual contribution and any shortfall in profit or loss and excess prepayment, everything can be transferred. The contribution based on the actuarial method and certified actuary. So you have to get the certification from the actuarist. And the insurer. Treatment as per 2 or once in every 3 years. So in this case, how do you account this in case of separate fund? Whatever the actual contribution you do know, debit to P&L account. Contribution is 10 lakhs. On retirement, you have to pay 12 lakhs. From this contribution, you can pay 12 lakhs. Another shortage is paid out of your own personal fund. So this one is already debited on creation. This one is also considered a shortfall, debited in the P&L account. If there is any excess, can be adjusted the next period. Okay, there is a prepayment also, advance payment like. Okay. Fund through insurer. The treatment is similar to this one. The premium what you pay can be debited to the P&L account. Okay. In case of leave encashment, accrual basis will be followed. To make you understand, we will discuss the illustrations also later. Okay. Then we will be more clear with this. Now, sir, what happens, sir, in case of VRS scheme? So you have two schemes, defined contribution scheme, defined benefit scheme. How the amount provided for this is treated? Where separate fund is there? No, sir. We pay as now and then whenever we are supposed to pay. Until that period, we can create the provision. Another model. Next is simply I pay the insurance premium and insurance company takes the responsibility. Last one being leave encashment. Accrual basis. Accrual basis means in this particular month, in this particular year, the employee is eligible for 40 days leave. He has taken only 30 days leave. 10 days leaves non taken, can be encashable. But he has not encashed, not taken. Then this can be encashable in the subsequent period. Means for this year, 10 days leave salary will be your liability. If he asks in the later period, it's your responsibility to pay. Leave encashment. In case of VRS, voluntary retirement scheme. Voluntary retirement scheme. Clear? Termination benefits to be paid irrespective of VRS. Whether it's VRS or not. If the employee worked for 20 years, 25 years, matter of another 5 years later, he is supposed to retire. What are the benefits a retiring employee will get? Gratuity, PF, pension, commuted, all these benefits are there. But if he, in addition to that, voluntarily resigns 5 years ahead, if he retires on due date, what are the benefits is eligible? No, that should also be payable. Apart from that, because of the VRS scheme, we have to pay additionally. So, termination benefits to be paid irrespective of VRS, that is PF, leave encashment, gratuity, that should be payable first. In addition to that, termination benefits on account of VRS should also be payable. What are they? Based on the completed years of service or unserved. We have seen that in taxation. In case of VRS, how many years he has completed into the salary for the period, average salary for the period, or number of months left unserved for that period salary. Between these two, whichever is lower will be considered as your expenses. Except gratuity, deferred revenue expenses, if savings in subsequent period also happens, okay, else it should be debited to the P&L account. These two costs are debited, except what? Gratuity related, deferred revenue expenditure subsequently means expenses will have the benefit only later period. That's called deferred revenue expenditure. In these two cases, that will be do no adjustment, leaving that rest will be debited to the P&L account. Okay, the retirement compensation, this amount will be directly debited to the P&L account, except this one. Now, finally, disclosure requirement. Method of accounting, what method of accounting you followed? Significant employees cost, how much employers cost for the various practices they follow should also be disclosed, whether it's a gratuity payment or PF gratuity payment or medical treatment payment. Statutory compliances separately, others as remuneration without specific disclosure. So you have to separately show this is a statutory requirement, the PF is a statutory requirement, and others will be named as remuneration. Statutory requirement will be stated properly, ESA contribution, PF contribution, and VRS contribution, and insurance contribution. Those things are legal, means it should be shown separately, rest will be named as remuneration. Actual valuation in financial statement is needed. Okay. See, if you have 1,000 employees, you are not sure how many employees will leave, how many employees will meet with accident in the coming years. In those cases, we supposed to pay some compensation. No, I'm not sure how much we supposed to pay the compensation. Then, based on the probability, we can estimate what is the amount we pay. That probability is done by actual valuation. So you have to consider actual valuation value also, and you have to show this also in your financial requirement, financial statement below that financial statement as a disclosure. Let's see. Lakshmi Bank has followed the policies for retirement benefits as under. Contribution to pension fund is made based on actuarial valuation at the year end in respect of the employees who have opted for pension scheme. Okay. So pension fund is as per what? Actual valuation they have created. Okay. Now what about the thing is? This is as per AS 15. They have correctly followed, don't do any more adjustments. Because pension means I am not sure how much pension I will pay. How much pension I will pay. If the employee lives for 10 years after the retirement, employer is committed to pay 10 years. Okay. See, because of the old pension scheme, that is called defined benefit plan. Earlier, no, before 2004, we have studied new pension scheme in taxation. New pension scheme, as per the new pension scheme, 10% should be contributed by the employer and 10% contributed by the employee. If the employee contributed for 15 years, after that he wants to retire, whatever the amount available in the contribution NPS account can be withdrawn as a pension. Once the amount is exhausted, he will get nothing. Is that okay? But earlier, old scheme, no, that's a defined benefit plan. Defined benefit plan means as per the current salary employees are drawing, retired employee will get 50%. Okay, my teachers in my days, their salary is only 10,000. Okay, only 10,000. Assume probably in 1990s, their salary is only 10,000. Great salary. By the time 10,000. They got retired in 2025. Eligible for old scheme. So this is the salary they draw. 2025 they retired, not 2025. Even one of my teachers retired in 2010 itself. Retired in 2010. Today, the same teacher's salary being 1,50,000. This teacher who retired gets around 75,000 rupees per month. During his work, he gets only 10,000 rupees. Today, he gets 75,000 rupees. How long will he get? One of the teachers, I had a chat. He is now almost 97. He retired at 58. Served for how many years? Probably joined by 20, early joining, 20 or 22. 58 means almost 40 years, less than 40 years. 50 to 97, 47, 40 years he worked and enjoyed. Thereafter lives for almost 47 years, enjoying so much of huge benefit. Then the government seems to be in trouble. That's why the old scheme was cancelled. Let's define. If I ask you, in CMA, no, that CMA is always a contradiction. In the syllabus, you have to study Company Act and Partnership Act, syllabus, and etc. Etc. means, do I want to study about the recipe for halwa? How the syllabus will have etc. Etc. means, what does it mean? Anything other than this will also be applicable for examination. Shocking. That's how the syllabus was drafted earlier. Surprisingly. which is always trouble. Then I have to go for the actuarial scientist. What are the questions may be expected with instruments in CMA in our examination? Those problem will be there. Define. These are the 5 topics I am going to ask in the examination. Master it. So now you confine what to study. This is called contribution plan. Whatever it may be, I assure you, I will support you. Then that is called define the benefit plan. The benefit plan is always riskier. So this is the benefit plan. Any amount the benefit stated by the company will be payable, which is riskier. Okay, it is as per AS 15 only. This is also suggested in the AS number 15, but actual scientists will be need for valuation. Contribution to the gratuity fund is made based on actual valuation at the year end. Yes, of course, gratuity fund can be contributed based on actual valuation. This is also as per AS number 15, correct? Because whatever the amount you are supposed to pay, if you are not able to estimate, then you have to depend on actual scientist. You got this value from the actual scientist and confirm. No problem. Leave encashment is in accordance with pay as you go method. Pay as you go method. If you leave, then I will pay. Then there is no formal structure. Okay. As you go method. Okay. This is not as per AS number 15. Why? Leave encashment should be in accrual basis. At the time of retirement, you tell me how many days you have not taken the leave, I will pay the cash. No. Each and every year, how many days you have not taken the leave, for that how much I have to pay money, no, that will be considered as leave encashment payable in the liability side. See, 40 days in a year, you can take the leave, but you have taken only 30 days. Company is liable to pay 10 days leave, no. So, you calculate the 10 days leave and state this outstanding leave encashment payable. Next year out of 40 has taken only 25 days. For the 15 again add, already there is an outstanding, again add this. Third year again 40 days he has taken 45 days. Now you can reduce the outstanding. Finally he leaves the organization completely, settle the amount and close this. That's the procedure. Accrual basis should be followed, not the actual basis. So they have followed the actual basis, not acceptable. It should be accounted for on actual basis. You can change this to accrual basis. You can change this to accrual basis in your question book. Now let's move on to the next illustration. Jindal Limited provides the following information regarding pension plan assets. Means contribution. Employer contributes the money in the pension plan whenever the employee retires and the amount is paid off from the pension plan amount. It's a separate fund they have. You are required to calculate employer's contribution to the plan assets for 2015. Now the question is how much they have contributed. How do you calculate? Like capital, opening capital plus additional capital minus drawings if any. The same happens here and profit is added. Similarly, it's a separate fund created. Fair market value of the plan asset in the beginning is considered as opening value. Actual return on plan assets during the period, this is the profit earned like. Benefit payments to the retired is a drawings like. So opening capital plus profit like, and this is drawings like. And fair market plan for the year end, this is the closing value. This is the closing value. Okay. If you subtract the closing value, the amount contributed can be calculated. So come on, tell me the value. 17 lakhs outflow, 13.2 lakhs you have in the beginning, 13.2 lakhs. The difference between these two is how much? 3.8 lakhs might have been contributed in this year. Additional capital like, What is the additional amount you invested? As this is the additional amount invested for paying the pension, is your expenses debit to the P&L account. Let's start with AS number 29, provisions, contingent liabilities, contingent assets. Three aspects are going to be covered. So, provision for doubtful debts. There's an expected loss, so you created a provision to meet the loss. That is called provision. Why don't debit that loss to the P&L account? Because we are not able to confirm how much will be the loss. So, it's only estimation. How much could be the bad debt? Maybe 5,000 or 6,000, I'm not aware about. So, I create a provision 5,000 or 6,000 rupees. On settlement of the loss, adjusting the loss, if there is any difference, I can adjust that routed through P&L account. That's what about the provision. Contingent liability. The liability supposed to be payable only on occurring some event. Mr. X has sued on me. My product is not good enough, so he sued on me. Case is there. If I get defeated in that case, I have to pay compensation. So now two problems are there. What? Will I defeat? Will I be defeated? Number one. No, sir. We are not sure. If I get defeated, how much compensation payable? No, sir. I'm not sure. Winning and losing also not confirmed. That fellow claimed 10 lakhs. Now, though I lose, I may demand to pay only 5 lakhs with the court. So, winning and losing also probability, and payment is also probability. Then, until that period, based on the expert's knowledge, your legal team says, sir, there's a chances of losing 60%. If I lose, what is the chance of paying 10 lakhs? Sir, the chance of paying 10 lakhs is only 40%. So, losing 60, after losing, only 40% chances to pay 10 lakhs. Means, I may pay less than 10 lakhs also. To that extent, I will create and show this as a contingent liability below the balance sheet. I will pay only on what? On confirmation. Then it becomes liability. If I win in the court, contingent liability disappears. If I lose, then contingent liability becomes liability. Until the temporary period is a contingent liability. Then what is a contingent asset? Reverse. I shoot case on somebody else. If I win, I will get the compensation, benefit. If I lose, I get nothing. Now, what is the probability of winning? What is the probability of losing? If I win, what is the probability of getting the money I expected? All these things are probability. Then automatically based on the, okay. Now, based on the probability, you can guess. Scope. This is number 29 non-applicable for financial instruments. Debentures, bond, for that this AS number 29 is not applicable. Those resulting from executory contract, okay, will not come under, provided if this is being contract is onerous. Onerous contract will be coming under AS number 29. Executory contract. I collected the money for that, now I have to finish up the portion. So, your side is over, my side is to cover the portion. So, that portion I am supposed to cover is called executory contract. I have to execute. That is called executory contract. That will not be coming under AS number 29. It's a guarantee liability. It is not coming under AS number 29. Contract is onerous. Okay, contract is onerous. What does it mean? I have to cover within this exam, not in the next exam. You paid me a fee, I will cover in the next exam. Wait. Just I am telling this before the examination. How will you feel? Huh? And you will demand to pay additional compensation because of meeting that. So that is called about other liability created because of non-fulfillment of something. That is called onerous. That is called onerous contract. This will come under AS number 29, but executive contract will not come. Now, insurance enterprises will have to pay. Okay. From contracts with the policyholder. That will not cover because insurance will come in totally different area. And those covered by another accounting standard. If this is covered under some other accounting standard, also not covered under this. Clear? Hope you will be now able to understand AS number 29. Let's see. What is called executory contract? Already referred. are contracts under which neither party has performed any of its obligations or both the parties have partially performed. You perform, but I have not performed. You also not paid fees, I have not covered. So that's what about both the party not performed or one of the parties not performed. This is called executory contract. Hope you'll be now able to understand. And what is called provision? Provision is a liability, but measurement is confusions. There is a pending measurement. Measured only by using substantial degree of estimation. Measurement is only estimated, not confirmed. Then it is called provision. What is a liability? It's a confirmed one. Amount is also confirmed one. And date of payment also confirmed one. So you have to pay. Okay. A present obligation. It's your obligation arising from past event. Okay. For example, creditors. Creditors 1 lakh. What does it mean? Creditors 1 lakh is your obligation to pay 1 lakh to the creditors. Why this 1 lakh comes? Because of the credit purchase happened in 3 or 4 months earlier, past events. Settlement of which this will be paid. How do you pay this? This will be paid by way of cash or bank means, which is expected to result in an outflow. It involves also 3 components. Creditors is a present obligation. Why this arises? Because of the past event. How this 1 lakh is closed? By involving some outflow. So outflow from the enterprise's resources embodying the economic benefit. Right? It's not only cash, some asset also be given to settle the liability. So to the creditors, I tell, sir, I don't have the cash out. One asset is ideally available with me. That's your requirement also. Take this for the settlement. So any asset you have can also be used for, means asset will decrease. This is called liabilities. This is called liabilities. Obligating event. Event. What's that event? Obligating means if I lose in the case, then it's my requirement to pay the compensation. Okay. If condition is there, if I lose, then I have to pay. That case judgment is an event obligating me to pay or not to pay. That is called obligating event. An event that creates an obligation. What is that? Judgment that creates obligation that results in enterprises having no realistic alternative. Once judgment is given to pay 5 lakhs compensation, I don't have any other options. I have to pay. I don't have any other realistic alternative to settle that obligation. But the judgment only if it happens, no, then it is called obligating event. What is the obligating event here? Judgment. For an example. Now, what is called contingent liability and contingent asset? In contingent liability, we have 2 classifications. Possible obligation, present obligation. Okay. Possible obligation that arises from past events. Okay. The existence of which is confirmed only by the occurrence or non-occurrence of one or more uncertain future events. So there's a possible obligation arises because of past event. Okay. And this will be based on uncertain future events. That event is not in my control. 3 component. What is an uncertain future event? Judgment. Case judgment. What is a past event? Goods sold. And that good sold damaged. Now he claims, sir, due the compensation. No, sir, we are not responsible. Then he goes to the court. And whether the court gives in favor or adverse, I am not sure. If it is in favor of the person who sued or in my favor, then okay, happy. In case if it is being the adverse, then I have to pay possible obligation. Can I escape? Once court gives the judgment, I cannot escape. That's why that payment is not in my control. Wholly within the control of the enterprises, not wholly. So I have taken an example here. Past event being the goods sold, sometimes later it got damaged. Immediately he goes to the court, and if the court gives us a judgment, I am not sure whether the judgment is certain or not. This is called uncertain. When later, uncertain future event. uncertain future event. Is that okay? Clear? Uncertain future event. And if this happens, then there's a possible obligation. Can I escape this some other more? No, no other way. Then it is called contingent liability. Contingent liability. Possible is very important. Now, present obligation that arises from past events but is not recognized. Okay, past event, judgment also confirmed. Judgment is pending. Okay, judgment may be in favor of me or not. Based on the judgment only, I have to pay. Then it's called possible obligation. Judgment is already given, so you lost. Now, the compensation demanded by him is 10 lakhs. Judgment is not in favor, but how much compensation is payable will be given in the next judgment. Court adjourned. I'm not sure how much I will pay out of 10 lakhs. It's 50,000 or 1 lakh or 2 lakhs. Okay. No probable outflow may be also possible, or reliable estimate cannot be made. Clear? In this case, this is called contingent liability. In this case, it is called as contingent liability. So, sale and damage and judgment and compensation. Okay, a diagram like you can write. Number 1. This one is yes. This one is pending. This one is pending. Then this is possible obligation. Second, this one is yes. This one is yes. This one is pending. And how much compensation? No probable cash flow, or not estimated. Then it is called present obligation. Present obligation. These two are called contingent liability. These two are called contingent liability. Clear? We have the two forms here. One is possible. We have the two forms here. One is possible obligation. Another one is present obligation. Now, in case of contingent asset, you have the same. You have the same. In a reverse case, what is that? Possible obligation similar to this one that arises from past events, the existence of which is confirmed only on the occurrence or non-occurrence of one or more uncertain future events, not wholly within the control of enterprises. Just reverse case will be contingent asset. Now you have to understand what is called present obligation and possible obligation. Already explained. Okay, present obligation already confirmed. Okay, but how much is not determined. Possible obligation, how much is also not confirmed. Payable is also not confirmed. Okay, present obligation. An obligation is a present obligation if based on the evidence available, its existence on the balance sheet date is considered probable. Whether winning or losing, I am not sure. More likely than not. Possible obligation, an obligation is possible obligation if based on the evidence available, its existence is not probable. Not probable means confirmed. This one is confirmed, there it's probable. Okay, what happens here? In this case, this is probable. This is confirmed. Confirmed. Confirmed, but how much is the question mark? This is present, that is possible. Hope. Okay, good. You will be now able to understand. Now, we will go for the recognition of provision. So, what happens, sir, in case of provision? Only if the following conditions are satisfied. An enterprise has the present obligation There is a probable outflow, reliable estimate. If all the three is there, then provision. Estimate is pending, then contingent liabilities or contingent asset. What is called present obligation? Already we have studied. Okay. So in case of present obligation, based on the evidence, where it is more likely that not the present obligation exists, not that present obligation exists, means how much you pay is a question mark, the provision. Okay. Where it is not, is more likely that no present obligation. You can skip this. Already I told you, present obligation. Okay. That's supposed to be estimation only pending than provision. And the judgment itself question means it is contingent liability. Okay. So no present obligation means possible obligation. Possible obligation. Possible obligation contingent. Present obligation with the value provision. Present obligation being provision. So past event already I explained with the example that leads to present obligation. Past event leads to present obligation. I sold damaged goods, that leads to give the compensation today, called as obligating event. Okay. And what is called obligating event? Everything is there. So penalties are cleanup cost for unlawful environmental damages. If you construct a factory, okay, now what happens? It spoils that environment here. While constructing the factory itself, the license giver, the government asked you to reset once you close the factory. That pollution, you created pollution and all, no, you have to clear that. So after closing this factory, now you don't have the revenue, but you need to spend the money for clearing the damages you created because of the pollution. Then for that you have to create the provision ahead. Okay. Penalties are cleanup cost for unlawful environmental damages. XYZ is in mining business. It is operating in a country where XYZ is legally bound to clean and restore the environment on expiry of license after 10 years. So they are bound to clear that place by the end of 10th year. XYZ can reliably estimate the amount required to restore the environment cost by the mining. So how much we have to spend also be calculated. Then automatically it comes under provision. Okay, why do I need present obligation? Probable resource outflow is there. Estimate also be reliably measured. Then of course you have to make the provision. Next question. A customer of XYZ has filed a case against them for providing them wrong product and not returning the same. XYZ has taken legal advice from their lawyer who believes it is not probable yet that resources may be required to settle the same. Treated as contingent liability as all the criteria required for the provisions are not met. Okay. So provision means it's confirmed liability, supposed to be payable later on, provision is created. But here what happens? Not probable advice given by their lawyer team. Legal team says, sir, we are not sure how much is payable. Then automatically it comes here. It will be considered as provisions only. So you have to understand the difference between provision, contingent liability and contingent assets. This is a treat given in CA Institute material. I just posted it for your better understanding. For your better understanding. So, present obligation as a resulting of obligating event. Yes, sir. Due to which probable outflow is there or not? Yes, sir. Can you estimate? Yes, sir. Then make a provision. What three conditions should be there? Present obligation, probable outflow, reliable estimate. Then provision is created. Now, probable outflow? No, sir. Probable outflow? No. Is that remote? Remote means suppose if there is probable, very rare scenario. No, sir, there is chances. Chances is there. Probable outflow, remote, but still there is small charges. Then contingent liability. Remote, yes sir, very rare sir. Very rare sir. Probable outflow, very rare sir. Very rare means why do you bother? But give a small hint or do nothing. Do nothing. Is it present obligation? No, it's a possible obligation. Yes. Remote? No. Then contingent liability. Sir, reliable estimate? Yes. Reliable estimate cannot be, sir. If you are not able to properly estimate, then it is contingent liability. Hope you will be now able to understand. Provision, contingent liability, not a provision or contingent liability case. So, probable outflow and reliable estimate and present obligation. Present obligation. Provision. Now, contingent liability. Okay. Present obligation. Okay. Obligation. No probable outflow. But chances are there. But not remote. This is contingent liability. Or no present obligation, but possible obligation, and compensation payable being not remote, then also contingent liability. If these two scenarios is not there, do nothing. If these two scenarios are not there, do nothing. Okay. What happens in case of restructuring? Last case, provision, contingent liabilities, contingent assets over. Now restructuring. A program that is planned and controlled by management materially changes either scope of the business undertaken by an enterprises or the manner in which the business is conducted. A big restructuring. Because of the big restructuring, the company's scope is either improved or decreased. And the manner of conducting also be totally changed. Okay, in that case, what happens? Provision for restructuring cost. You have to create the provision. Suppose to do a restructuring of your business. How can you make the provisions for that? Accounting. In that provision, these things are included, these things are not includable. So, existing business you have, you terminate that lease contract, that cost will be includable. You have contract with Mr. X, because of the change you totally terminated, you have to restructure by framing a new concept. Otherwise, you don't now depend on Mr. X. Cost representing contractual obligation with no economic benefits. Any other contractual obligations, because of the termination, you may demand, sir, you should not terminate. If you terminate, you violate it. So, you have to pay me a compensation. I don't have any other chance to escape. Because of this payment, I don't get any more benefit. There is no any economic benefit. And these two costs are includable. And what are the costs are excludable for restructuring? Cost of refraining, don't do. So I spend the money not to doing. Marketing cost and expected loss on sale of assets. Whatever the assets you have currently, because of restructuring not required, no, can be discarded in the market. Because of discarding, you may face loss not required. In case of new investments, you would do, can also be considered as not being the restructuring cost. New investment being the asset. This is sale of the asset. These are amount debited to the P&L account. Now, what are the content you are going to disclose in your balance sheet, below the balance sheet? Disclosure for provisions. Whenever you have the provision, what is the opening, what is the addition in this period, and unused provision if any, what is the closing balance you have, any reimbursement you can recover because of this provision. So, all these details you have to maintain. Provision for doubtful debts. Okay, opening we have 100. In this period we created 50. Okay, sorry, you created another 50. Unused provision out of 100 rupees this year, 70 rupees used for adjusting the bad debt. Balance 30 will be called unused provision. What is the closing balance? Closing balance is nothing but these two 80. That's how all the details are mentioned here related to the provision. Similarly, in case of direct contingent liability, it can be disclosed in director's report. This will be a part of balance sheet item. This is not part of the balance sheet item. A small note will be there. Nature of this one, estimate, indicate. Now, we'll discuss the illustration here. At the end of financial year ending 31st December 2021, a company finds that there are 20 lawsuits outstanding. So this fellow has 20 lawsuits, okay, outstanding which have not been settled till the date of approval of accounts by the board of directors. Everything is pending. We may either win or lose. If we lose, then we have to pay the compensation. We are not sure how much compensation is payable. Possible outcome as estimated by the board is as follows. In respect of 5 cases, okay, maybe contingent liability. In the next 10 cases, 50 cases probability of win is there. So, no contingent liability. And we lose with low damages. In case of low damages, you have to pay 1,20,000. High damages, you have to pay 2 lakhs. Low damages case being 40%. Then 1,20,000 into 40% being 48,000 will be the contingent liability. High damage case, you have to pay 2 lakhs. What is the percentage of paying this? 10%. 10%. 20,000 rupees. 20,000 rupees. Now, total contingent liability. Nil. Here, okay. Here, this is per case. How many cases are there? 10 cases. So the total value being 4,80,000, 2 lakhs. Okay. This is per case basis for the total being 4,80,000 and 2 lakhs. Remaining 5 cases win probability being, so out of 20, 5 winning, 10 this way, another 5 being this one. Winning 50%, you don't create any provision. Losing with low damage, 1 lakh you have to pay. For that 30%, 30,000 rupees is payable. Here high damages, 2 lakhs 10,000, 20%, 42,000 rupees will be payable. 42,000. And total contingent liability in this case being, for 5 case no, 1 lakh 50. This is 1 lakh 60. Sorry, 2 lakhs 10, I think. Yeah, 2 lakhs 10,000. Overall provision created in this case being 10 lakhs 40,000 rupees. Clear? Shall I go for the next one? Now, E Limited is in the process of finalizing its accounts for the year ended 31st March 22. The company seeks your advice on the following. The company's sales tax assessment for the assessment year 21-22 had been completed on 14th February 2014 with a demand of 2.7 appeal before the appellate authority. To prove your genuinity, first you have to pay this money and then apply. If your case is right, upheld in appellate authority, will refund. That's the case. Now, because of that reason, because of appealing with the appellate authority, he pays this. While paying, he pays, sir, I don't accept this one. Anyhow, to appeal only I am paying. Appealing is not confirming that I am going to pay as per your expectation. I am wrong. No, I am not wrong. For appealing purpose, I am paying this. 2.76 is paid under protest. Under protest. Okay. The company filed its appeal before the appellate authority, wherein the grounds of appeal covered tax and addition made in the assessing of order for a sum of 2.10. Out of this, for the 2.10, he is not accepting. For 2.1, is not accepting. For the balance, okay, sir, it's my fault, I will pay. Now, what is the scenario? The company seeks your advice. This is already confirmed, Okay. Then you already accepted. Then it's not a contingent liability. And which is the contingent liability? The amount you paid under protest, you're supposed to go for court. You may win the case. If you win, then you'll get the 2.1 lakh later. If you have strong belief that there is a chance of recovery, then you can consider this being considered contingent liability. Clear? Second question. The company has entered into a wage agreement in May 2022, whereby the labor union has accepted a revision in wage from June 2021. The agreement provided that hike till May 2022 will not be paid to the employees but will be settled to them at the time of retirement. The company agrees to deposit the arrears in the government bonds by September 2022. Okay. So what happens? May 22, we start with April 22, ends on March 23. March 23. In this date, there's an order to revise the wages and asking them to pay from June 21 onwards the wage revision for this period. Okay. Probably the salary payable in this period being only 10,000 rupees. May, they stated the salary is not 10, it is 15,000 rupees. Do I want to pay 15 from May onwards? No. You have to pay 15,000 from this date itself. So from June to May, per month 5,000 means how many months are there? 12 months. 12 months, right? June month, we start with the June month and up to May end, 12 months we assume. 60,000 rupees is arrear to be payable. Arrear to be payable. As arrear 60,000 is to be payable, remember, the company says, sir, I don't want to pay this now, but I will deposit with the government bond. At the time of retirement, he can withdraw. I don't have the cash. So, this is how the judgment is given. The company agrees to deposit the arrears in government bonds in September 22. When? September 22. Now the question is, up to that period, it is a provision. Because it's a provision. Already it's a confirmed one, you have to pay. There is no chance to escape. As you don't have the chance to escape, that is only provision, not being the contingent liability. Clear? Now, A is number 4. A is number 4. Contingencies and events occurring after the balance sheet date. Contingencies, events after the balance sheet date. AS number 5. AS number 5. Net profit or loss for the period is and estimates. This AS number 5 title will not have the estimate, but this includes change in estimate also. Title will not have, but there will be provision for this also. Now I will cover AS number 4 and 5 simultaneously. So I want to prepare an accounts for this period 1/4/2025, and this accounting year ends on 31st March 26. This is what about the accounting year. Beforehand and after this. After this date, but up to approval of your report, financial reports by board of directors. You have to understand these are the three blocks: block 1, block 2, block 3. Now, what we have to do? We have to find out what is the profit for the period, net profit for the period. Okay. And what happens anything in this period to be adjusted here? Will you record anything related to this period in your financial report for this period? Usually not so. Rent per month 10,000 rupees per annum, it should be 1,20,000. But you paid only 1,00,000. 20,000 is outstanding, it should be added. Now tell me, okay, here, wages 10,000 rupees. Will you incorporate that here? That wages related to that period? Usually you will not incorporate, provided this is nothing but wages paid for installation of plant and machinery wrongly debited to the plant and machinery, wages account. Then what happens here? We calculated wrongly by debiting the wages which is wrong. Now I have to rectify. How do I rectify? I have to now raise the plant and machinery. Plant and machinery should be debited rather than wages account. So any transaction related to the period prior 1/4/2025 is called prior period items. Okay. Prior period items. Clear? That prior period items, you know, is nothing but error only. Error and omissions. And you have to find out the profit and loss for this period. Insolvency petition. But how much will be bad debt? I am not sure. Whether full amount or partial amount, I am not sure. But before this date, there is a judgment. In this date, there is a judgment stating that that fellow should pay only 60% out of every 1 rupee. 60%. So from the 1,00,000, I am sure now 60,000 is recoverable, balance 40,000 non-recoverable. The non-recoverable 40,000, you know, bad debt. Now my question is, do I want to show that 40 as my bad debt in my P&L account for this period? Or this bad debt is confirmed here only now? Do I want to show this bad debt being this period? Then any situation exists on 31st March, valuation only is confirmed, pending. That also confirmed, and we can estimate perfectly because of event happened in this period. Events occurring after the date. Events after balance sheet date. Clear? From this it is very clear, three aspects are going to be covered. Under what's AS number 4 and 5. Under AS number 4, we are studying about contingencies and events occurring after the balance sheet date. This will be AS number 4. This part will be AS number 4. And these two will be called as AS number 5. Okay. While calculating the net profit for the period, you have to incorporate if there is any change in accounting policies like SLM method to WDV. This will be called as change in policy. You have to incorporate. And original value of the scrap value of the asset being 10,000 rupees, now you came to know the value being only 5,000. Or the life of the asset being 5 becomes only 2. And it is nothing but change in estimate. So from this very clear, under AS number 5, 4 aspects are going to be covered. Prior period item related to error and omission. Number 2, net profit or loss for the period. Otherwise, profit or loss for the period. Number 1. Number 2 being prior period item, error and omission, how do I handle? Number 3, changes in policies. With the changes of policies, changes in accounting estimate also be incorporated. So 4 aspects. Clear? So the 4 and 5 you have to study parallelly. Let's start with this one. AS number 5. What are the things we have? Net profit or loss for the period, prior period items, changes in accounting policies and the estimates. Net profit or loss for the period. The following components disclosed on the face of the statement. On the face of the statement means in your P&L account, the first page itself should be there. Don't say note, go and refer there. It is not accepted. Okay. Profit or loss from ordinary activities, extraordinary activities, exceptional items. Okay. All the 3 should be shown. Okay. Then you can find out the net profit. So, while calculating the net profit, what are the things will be there? Net profit or loss from ordinary, extraordinary and exceptional. We have studied the company's final accounts, schedule number 3. Profit before ordinary, profit before extraordinary, exceptional item. Then profit after exceptional, then profit after extraordinary and exceptional. That's how we learn. While teaching that company final accounts, so prime land I have, government wants to expand the bus stand, then they immediately grab my land. It is not ordinary, but my asset has gone. It affects the business extraordinary, not ordinary. Earthquake like natural calamity. Will it be happening now and then? No, it's very rare. Rarely happening situations. An earthquake. Okay, exception. Insurance claim for loss in earthquake for its worth, then you will be very happy that's a profit situation. So you will either have the profit or loss, and due to the earthquake also, those are called extraordinary item. Now you have to understand what is called exceptional item. Okay. Ordinary activities, but size, nature or incidents may need to disclose separately, because usually our sales is around 10 lakhs per month. Suddenly one new order came in June month, I got around 50 lakhs rupees worth of order. Is it happening always? No, very rarely. So you have to disclose this month we got extraordinarily different, exceptional case. Okay. So may need to disclose separately. Such a classification is not available in schedule number 3 of the Companies Act. Under Companies Act, no, this classification is not there. But the statement preparation under AS also, they have given the statement, exceptional item, but not required for the AS means schedule number 3 purpose. Example, writing down of inventories to NRV and reversal, inventory writing down, cost of restructuring activities, disposal of fixed assets, disposal of long-term investments, legislative changes having retrospective application, litigation settlements, other reversal of the provisions. Okay, these are also be happening now and then, but exceptional case. It's not related to your normal ordinary business. What the purpose you started, you know, for that purpose, any activity is there, no ordinary. In that, there is a answer like rarely happening. Volume also higher than it's called exceptional item. Earthquake and the attachment of your property are the good examples for the extraordinary. That is not expected for the company. These things are expected for the company only. Exceptional are expected for the company, but volume is high and not related to your direct sale of goods. And net profit for the period being ordinary item, extraordinary, these two. Apart from that, prior period items, errors and omission, if any, should also be adjusted to find out the correct profit in this year. Last year, wages is directly debited to the P&L account, but it is meant for the plant and machinery installation, so it should be debited to the plant and machinery. So in this year, you have to rectify, and plant and machinery is increased. By increasing, the depreciation also be increasing. No, that is what about the reflection of the prior period items will be shown in the current year. And changes in accounting estimates and changes in accounting policies also be studied here. Now, what is called prior period item? Prior period item, income or expenses in the current period due to errors and omission in the period, prior period. And you have to disclose separately in your P&L statement. This should also be disclosed separately. These things are disclosed separately. Okay. Disclosed separately. Extraordinary, exceptional and prior period rectification errors also be stated properly below the balance sheet. Say, this year my profit got affected due to the extraordinary item, this much amount, exceptional item, this much amount, and prior period item rectification, this much amount. You have to state it properly to find out what is the exact profit in the current year. Clear? Now, we'll go for this. What is that? Changes in accounting estimates. Changes in accounting estimates. Example. Changes in value of PPE. Okay. Estimate changes. Life it has. Then the expert valuer says, sir, the asset was fairly used, maintained good, so still it has another 4 more years. Now, in the third year, you have to depreciate based on the 4 year in the denominator, not the 3 years. This is all about estimation changes because scrap value and life of the asset is only estimation. So the estimation may be always changing. Based on the current date, I estimated 2 or 3 years later by getting some additional data. If I estimate, the value is totally different. So different value is now followed here. After following, what is the profit impact? Impact on the profit, you have to disclose it separately below the balance sheet. This is called changes in accounting estimates. Changes in accounting policies. Already we studied the changes in accounting policies. A is number 1. Okay, A is number 1. How do we study? Can we change the accounting policies? Of course, you can change, provided it should be required by the law or accounting standard, or you feel it's a better presentation. The same comes here also. So this one and A is number 1 are interlinked. And statute, accounting standards, and for better presentation, you can change. Right. And any changes in the accounting policies with the impact on value should be, if it is material, you have to disclose, and prior period items should also be disclosed. Okay. How can you choose the best accounting policies? We have seen under A is number 1. Okay. If accounting standard says, then you can take that. Otherwise, any other better method you feel you can choose. That's how we have seen true and fair prudence method also be adapted. A is number 1. Here. Not changes in accounting policies. Not changes in accounting policies. Adoption of an accounting policy for events or transactions that differ in substance from previously occurring events or transactions. This is not changes in accounting policies. Okay. In employee benefits, we have retirement benefits. There ad hoc benefits also there we have studied. For the ad hoc benefit, what will not be applicable? Okay, employee benefits under AS number 15 will not be applicable. That's what we studied. So the company followed ad hoc model for employees benefit for past years. This year they want to follow defined benefit schemes or defined contribution scheme. So earlier being not as per AS number 15, now as per AS number 15. If you are transferring your policy from here to here, is it coming under changes in accounting policies? Means no, sir, because it is not as per AS. No. So will be considered as introduction of new policy for the AS. So it is not considered as changes in accounting policies. Introduction of formal retirement gratuity scheme by an employer in place of ad hoc gratuity ex gratia payment to employees on retirement is not considered as changes in accounting policies, because This is not accepted. This one is accepted. Two accepted accounting policies, if you are changing, then it's called changing of accounting policies. And this is the first time we plan to adaptation of new accounting policies in this first year. Not occurred previously. We don't have some similar accounting policies in the previous year. First time adoption is not changes in accounting policies. First time adoption of recommended means stated methods in AS also be considered as not changing accounting policies. If you have been given two accounting policies, SLM and WDV, you already follow SLM, which is also accepted method. Now you want to shift to WDV method, then it is called changes in accounting policies. Changes in accounting policies. Is that clear? Now, hope now you'll be able to understand this diagram. So, what are the things we have? In net profit for the period, 3 items: ordinary, extraordinary, exceptional. Ordinary, it's business operation. This is also business, but not directly their own goal or operations, but volume is different. Volume different. And extraordinary, not at all related to the business, like earthquake, natural calamity, or government attaching your property. These activities not directly related to your business. This is not stated in schedule number 3 of Companies Act, but these two are definitely you have to classify separately as per schedule number 3. And we have still changes in policies and changes in estimate. So all these things are dealt under AS number 5. And this one also we understood under AS number 5, prior period terms. So 4 aspects, 1, 2, 3 and 4th one also being this. Now let's go for the events after the balance sheet date. Before we solve the illustrations in these two topics, I try to finish up events after the balance sheet date also, right? Now, contingencies. So just now we learned the contingencies are again contingency. All the contingencies are now coming under AS number 29 only. Only 2 contingencies are covered here. Only 2 contingencies. Right. Clear? What are they? PDD, provision for doubtful debts, and proposed dividend. Only these 2 are now covered under this accounting standards. Okay. 2 items, PDD related and proposed dividend. Only these 2 are covered. Provision, contingent asset, contingent liability. In these 3, these 2 are coming under this case. Okay. 2 others and this one will all come under AS number 29. In contingent liability, 2 items will come under AS number 4. That's all. Rest of the understanding are similar to the item what we have dealt under AS number 29 will be applicable. Okay, sometimes later, if these 2 points also incorporated in AS number 21, this AS number 4 will be scrapped. Waste. Okay. Earlier, no. We don't have AS number 8. We don't have AS number 6. Now the name is also not in my mind because it's now already scrapped, very old. AS number 28, 26. AS number 26. AS number 26 is intangible assets. Patent, brand name, all are intangible assets only, no. So they introduced AS number 26 newly, then 8 scrapped because this one also incorporated the AS number 6 depreciation. In AS number 10, property, plant, equipment and component based depreciation model is introduced there itself. So AS number 6 was removed. I thought this AS number 4 also be incorporated in AS number 21, so 29. So AS number 4 may be scrapped, but still they have not removed. Expected to remove, but still. So from this it is very clear. You understand 29 the same, but in case of 2 contingent assets, a contingent liability will be coming under AS number 4. Clear? So provision all similar to AS number 29 only. contingencies, situation which gain are all the things are same. According treatment of contingent losses, probable, reasonably possible, remote. You can skip this. If you study there, you can skip this. Events occurring after the balance sheet date is very, very important. As on the date of year end, 31st March 2026, okay, there is something exists before the approval of board of directors. Board of directors confirmed, then it is an adjusting event. Adjusting event. I'm not sure what is the amount I am payable, but payable is confirmed on this date. Then it is events occurring after the balance sheet date. Events. This one is called events occurring after the balance sheet date. Something happened here and confirmed here. This will not be considered as adjusting event. Adjusting event means you have to show in your books. Something is here, but happened only after board of directors here. Also be not considered. So my concentration is only this part. Means as on the year end, there is a slight doubt. But what is the value? I'm not sure. That value is determined because of some event happening between this period. Only then that will be the adjusting event. Only then this will be the adjusting event. So adjusting event. Evidence of such condition has been existed at the balance sheet date. On the date it should be existing. Adjustment to the assets and liabilities is required. Example, PDD. Okay. And also disclosure in the financial statement is also required. This one, PDD, usually to be adjusted in the asset, but no need to adjust, only show this as a disclosure. For the proposed dividend, though the event occurring after the balance sheet date, it should be only a disclosure form, not adjusting form. So here, this will be adjusted by subtracting from the asset. This will be only what? Below the balance sheet. Disclosure form. You no need to adjust this. Only two items. Only two items. The rest will be directly dealt under AS number 29. Because this proposed dividend is only to be disclosed as per the legal requirement of Companies Amendment Rule 2016. Companies Accounting Standards Amendment Rule 2016 says proposed dividends should be disclosed, not being the adjustable item. Clear? Now, what are called non-adjusting event? Two adjusting event, one is adjusted with the asset, another one is disclosure. What are the non-adjusting event? No evidence on the balance sheet date. Okay, no evidence. Then sometimes you can give a disclosure. Adjustment to assets and liabilities not required. Example, loss in investment due to market fluctuation after the balance sheet. I'm not sure whether the share price is decreasing or increasing because of the market situation, which is a normal, not adjusting event. Disclosure may be required. When? Disclosure in the report of approving authority is needed if the loss is affecting the financial position of the company and affecting the going concern concept, then disclosure is required. Only disclosure, not adjusting event. So, two items only discussed here. One is PDD, which is going to be subtracted from the balance sheet, provided there should be a situation exist on 31st March. Everything happens after this, then that's not event occurring after the balance sheet date. Sometimes not as on 31st March, but something happen which abruptly affects the business, not adjusting event, at least give a note. Okay, even though it is not even occurring the balance, it's not even occurring after the balance sheet date, but volume is high, no, give a small note. In case events indicating going concern assumption inappropriate, if it affects the going concern assumption, then you have to start prepare the accounts under liquidation basis. Liquidation basis means whatever the assets you purchase and use it for the business, you show at what rate. Net book value, original value minus depreciation, that's the value you have to record. But if I sell the asset, at what rate it will go? That is called scrap value only you go. It will go. So, for example, the TV I have here for displaying the lecture, purchased around 50,000 or 60,000 rupees, I think. Okay. Now, if I sell, at what rate it will go? Not more than 10 to 15,000 rupees. But I will show this TV in my books as 30,000 rupees. Because every year I depreciated 10,000 rupees. For the 2 years I depreciated 20,000 rupees. Today the WDV value being 30. If I want to close my business, I can sell it for how much? Only 15. So in my balance sheet I have to show the asset value to be only 15. The same happens for the table and benches. The table what we have here depreciated the normal depreciation rate of 10%. If I want to sell, will I be able to sell for the rate? No, it's very lesser. So if the entity gets affected or will going concern concept seems to be doubtful, then you have to follow liquidation basis. Scope. Not applicable. Contingencies covered under other areas. Only 2 applicable in case of impairment of financial assets, especially receivables. PDT. Only for this one is applicable. Rest will not be applicable here. Disclosure, the nature of events occurring after the balance sheet date and financial effect. These 2 are disclosed. Okay, nature of events occurring after balance sheet date. My customer becomes insolvent, so the amount recovered will be doubtful. Number 2, because of that, I may face bad debt of 50,000 rupees. You have to disclose. In X Company Limited, theft of cash 5 lakhs by the cashier in January 2021 was detected only in May 2021. The accounts of the company were not yet approved by the board of directors. So, we directed before the board of directors approval. As on 31st March, definitely it exists. You are not aware about that. We directed on this date. So, it is an adjusting event. Even after the balance sheet date. This will be called as event after the balance sheet date. Not only that, you have to adjust this. Whether the theft of cash has to be adjusted in the accounts? Yes. This is events occurring after the balance sheet date. An earthquake destroyed a major warehouse of ACO Limited on 25/2022. The accounting year of the company ended on 31st March 2022. So the earthquake itself happened after the balance sheet date. As on exactly on balance sheet date, it doesn't exist. So is it adjusting event? No, it is not adjusting event. The accounts were approved on this date. The loss from earthquake is estimated 30 lakhs. If the loss is huge, affects the going concern concept, then you can better disclose at least. Assume that due to the earthquake, huge loss happened. Not an adjusting event, but you can disclose this. Even if the going concern concept will not be appropriate, then what happens? You can follow liquidation method. So these are the 2 points. Next. Fourth, in preparing the financial statements of all following information, state with reason how you deal with this in the following statement. Number 1, company invested 100 lakhs in April 2021 before approval of financial statement by the board of directors in the acquisition of another company doing similar business. This happened on which date? April 2021. As on 31st March, we don't have any such a hint. So what happens then? It is not adjusting event. Okay. Not an adjusting event. Okay. Not an adjusting event. I missed the third one. Let me finish up that one. The company has filed a legal suit against the debtor and approved by the board of directors on 20th August 2021. Closed on this date and approved on this date. The company was engaged in laying pipeline for an oil company deep beneath the earth while doing the boring work in 1/9/2021. Everything happened after board of directors date. After board of directors means then definitely you will not take. It will not be in adjusting. You don't bother about that at all. You no need to adjust. You no need to disclose. We already signed. How will we know about this one, right? While preparing its final accounts for the year, the company made a provision for bad debt being 5% of the total trade receivables. The last week of February, a trader receivable 2 lakhs had suffered heavy loss on which date? This date. Before the closure itself, we came to know one of the customers lost hugely, heavy loss due to earthquake. The loss was not covered by the insurance policy. So huge loss is there to my customer. Definitely the position is weaker, but I am not aware about how much I will recover or how much not recoverable. In April 2021, the trade receivable became bankrupt. Can the company provide for full loss? Yes, definitely, because the situation already we came to know on 31st March itself. Only the valuation is confirmed after the date, before the board of directors approval date. Now, 7th one. During the year 21-22, Raj Limited has sued a competitor for rupees 15 lakhs for infringement of a trade deed. Okay. Based on the advice of the company's legal counsel, Raj Limited provided a sum of rupees 10 lakhs in its financial statement for the year ended. Okay. And on 18th May, the court decided in favor of the party alleging infringement. So, case filed. We have doubt, immediately we made a provision, but we are not sure how much we will pay. As we expect, May itself we came to know that we failed in that case. The trademark and ordered Raj to pay aggrieved party a sum of 14 lakhs. Already we have created provisions 14 lakhs, but now you just create only 14 lakhs as a adjustment. Current liabilities, balance 1 lakh, you can reverse. You can reverse. Is that clear? No, 10 lakhs only created. 50 lakhs is the expectation, but we have created only 10 lakhs. But finally, it's 4 lakhs means 14 lakhs means you have to further create another 4 lakhs. Is that clear? So with that, A's 4 related practical questions over. Now let's go for the 5 related practical questions. 5 related. A is number 5. Fuel surcharge billed by the state electricity board at provisional rate. Final bill for the fuel charges being 5.3 lakhs for the period October 2021 to September 2017. Okay, 11 to 17 has been received and paid in February 2018. However, the same was accounted in the year 18 and 19. Comment on the accounting treatment done in that said case. So, this is related to which period? 11 and 17. We are preparing for this year, 18 and 19. While consuming the fuel from the state electricity board, we paid roughly. State electricity board told whatever the amount you pay, it's an only estimation base, will give proper bill later on. So now they gave the bill, you have to pay additionally for 5.3 meant for this period. Now the question is, can it be debited to the P&L account? Yes, can be debited, but it may be specially named as prior period item, error and omission. Under AS number 5, we have 4 aspects: prior period item, net profit for the period, and then changes in the estimation, changes in policies. In case of net profit for the period, we have the ordinary, not ordinary, extraordinary, and exceptional. So these are the items. So you have to keep that idea in your mind. In this case, this is not related to 18-19, definitely it's a prior period. During the year 21-22, a medium-sized manufacturing company wrote down its inventories to net realizable value by 5 lakhs. So, they are writing down the NRV. It's a separate disclosure required, so it's an exceptional item. Okay. So, exceptional item. I have given the example here. Writing down the inventories to the NRV is being exceptional item. You can do a small disclosure. You can give a small disclosure. Okay. Now, in the text, exceptional, but it is related to your ordinary business. It's not extraordinary. Exceptional also ordinary, ordinary also ordinary. But exceptional means size is different. Extraordinary means not related to your business, like earthquake, attachment of your property by the government. Okay. So that's why in the answer I have given ordinary and need disclosure for adjusting the stock. That's how it's given. In case of exceptional, disclosure required. But in case of ordinary, other than exceptional, no adjustment also, no disclosure also required. Is that okay? Exceptional, disclosure required. Extraordinary, disclosure required. But ordinary, no disclosure required. Is that clear? Next. The company signed an agreement with the employees union on this date for revision of wages with retrospective effect from this date. Okay. This would cost the company an additional liability of 5 lakhs per annum. Is the disclosure necessary? So this is related to our current period only. Current period only. And also, the revision of wages is decided by employee union. Then it is not prior period item, it is current one. But it is material. Okay, exceptional item. So disclosure required. Okay, net profit for the period. No. Why? So yes, this is net profit for the period. It is not related to the prior period items. See, in the year 22-23, you made an error or you omitted or because of some measurement requirement, I kept it pending. In 23-24, it is confirmed and you are paying or adjusting this and adjusting this. Then this will be called as prior period item. In this case, the wage revision 5 lakhs related to this period, by this time, it is not error or omission. I am not committed to pay 5 lakhs extra in the year 22-23. In 23-24, union came for strike. In order to convince them, I accepted, okay, I'll pay 5 lakhs extra. When I convince them to pay, accept to pay, in this year only. So the decision of paying this 5 lakhs for the year onwards, apart from the previous year also, happened only in this year. It is not error or omission in the previous year. Is it an error? No. Is it the omission in the previous year? No. Because by the time I am not aware about that. But earlier case, electricity case, I know that anyhow the electricity company will raise further bill. So I am not aware about what's the bill. Then it is related to that period. But here, I am not sure whether the employee will demand for extra salary for the earlier year also by the time. Now they demanded, accepted in this year, so it is related to the current period. It is not prior period item, it is related to the current year and exceptional nature. Will be exceptional nature. Is that clear? Next. Next. The company finds that inventory sheets on 31/3/2021 did not include 2 pages containing details of inventory worth 14.5 lakhs. What happens here? This is only error. They forgot to add 2 pages inventory detailing 14.5 lakhs. Still, how will you deal with the following matters in the accounts of Omega for this year? In this year, how can you work out? This will be definitely prior period item. Omission, error and omission related to the previous period is called prior period item. It should not have the impact in the current year profit. You have to disclose what is the current year profit, what is the profit we supposed to adjust due to the previous period. You have to show separately. Right. This one already we studied. Introduction of formal retirement grading by an employer in place of ad hoc gratuity. Already we studied, no? Ad hoc. Is it change in policy? No, because first time introduction is not change in policy. Already we saw in the same example. Management decides to pay pension to the employees who have retired after completing 5 years of service of the organization. Such employees will get pension of rupees 20,000 rupees per month. Earlier there was no such scheme. So this is also first time adoption. This is also first time adoption of the AS based or legal requirement based method. Here There is no such method we plan to adapt first time here, so it's not change in accounting policies. Clear? With that, A is number 4 and 5 over. A is 4 and 5 over. We'll now deal with A is number 7 and 9. These two accounting standards are named as revenue based accounting standards. Out of your business, how much revenue and what time you can recognize? That is going to be studied under AS number 7 and AS number 8. AS number 7 is related to the construction of contract related revenue. AS number 9 is all about normal sales of goods, rendering of services and all. If I sell the goods, when can I recognize the revenue? The moment the good is handed over to him and cash is realized or guarantee and realization, then we can recognize. What happens in case of service? The same way. Service completed and cash is recognized. So some variation also we will be studying that. That's all. Only these two aspects are going to be covered. Especially construction of contract has some illustrations. We will be covering that. Construction contract includes not only construction of assets, it includes demolition of assets also. Demolition and restoration of assets. These are called construction contracts. And for whom this AS number 7 is applicable? It's a revenue recognition. Is it revenue for the contractor or contractee? Only for the contractor it's a revenue. So it is applicable for the contractors only. What are the types of contracts we have? We have fixed price contract and cost plus contract. Fixed price means A and B. A needs a house property to be constructed and B says, okay, I will construct for you. Okay, so now B accepts to construct the house property and hands over to A. And he states, give me 100 lakhs. Give me 100 lakhs. Then this 100 lakhs is called contract price, fixed price. Then they enter into contract and they will do the business. It will take around 2 or 3 years also. As the contract period is more than 1 year, 2 to 3 years, how can I recognize the revenue for the first year? That's the problem, you know. So, if the contract is only for 1 month, finish off, get the cash. But in case of construction of dam and any other bridge, it takes at least 5 years and 10 years. As I am being the contractor, how can I wait for realizing my profit for 10 years? No, it's not possible to wait for 10 years. So I have to get the revenue as soon as possible for every year. Then how can I identify the revenue for every year? That is going to be studied under AS number 7. This is fixed price contract. The another one is very simple. Whatever the expenses you spend, you know, sir. For example, for construction, if you want cement, purchase this and give me. And we need to have the laborers. I'll use the laborers for construction. You pay the salary to them. As I am being the contractor, having the skill of engineering, civil engineering, I'll support with my engineering knowledge to complete the construction. For me, give me 10%. So this is called cost plus contract. Cost plus contract. Hope you'll be now able to understand the logic. Why do I want to study AS number 7? To find out the profit recognized for every year where the project runs for more than 1 year. How can I determine the profit or loss? We have percentage completion method, stage completion method. Okay. So we have the profit and loss. In case of profit, we need to use percentage completion method. Okay. In case of loss, 100% you have to recognize. 100% you can recognize. Debit to P&L account. For example, in that project, you think you will get 10 lakhs rupees profit. Currently, 60% completion over means out of the 10 lakhs, 60%, 6 lakhs will be your income for the year. Okay, 6 lakhs will be your income. Suppose if you complete, you face a loss of 4 lakhs. 60% completion, how much will be taken? All the 4 lakhs will be recognized. In case of loss, recognize immediately fully. Though it takes another 1 year to face all the loss. Anyhow, you have to recognize fully. In case of gain, to the extent of completion, you have to recognize. How can you find out the completion? Okay. maybe cost to date divided by total cost. That's how we'll recognize. Okay. I saw an illustration, then you'll be able to understand. To complete this entire project, no, the contractor A estimates he has to spend around 80 lakhs. But currently, they have spent around 60 lakhs. Means out of 80, 60 lakhs is over, means 60 by 80, 75% is the level of completion. How do you find out what is the level of completion they have done? Up to now, how much they have spent? 60. For the remaining, how much he has to spend based on the estimation. So 60 is the actual one, but another 20 is the estimation. So 60 plus estimation 20, the total cost being 80. In that 80, currently 60 over means 75% is over. So you have to find out the profit. In that profit, 75% can be taken as the profit for the current year. Every year you have to go for that. Before I go for subsequent learning or guidance, let me finish off an illustrations for your better understanding. Okay. We'll start with the first question. Profit contract question. The contract gives profit. How can we handle? Proportionate completion method or percentage completion method is going to be followed. Now tell me. Compute the and contract revenue and cost to be recognized from the following data. Contract you'll get how much? 150. 150. Material cost to date 36, unused 6 lakhs. Then how much you spend for material? 30 lakhs you spend. 30 lakhs you spend. And labor paid for workers engaged 24 lakhs, 4 lakhs still payable. Then what about the labor cost you spent up to now? 8 lakhs. Payable means outstanding should be added. Right. See, outstanding and advance, like the same logic is applied here. Specific contract cost, other cost related to this contract, specific contract cost. Subcontract for work executed. How much is this? 10 lakhs. Advance to subcontractors, 6 lakhs. Advance given. Advance given is not current cost. So subcontractor cost. This is what about the total cost to date. Cost to date. This is called cost to date. Until today, how much you spend? 80 lakhs. What is the further cost? Estimated further cost? Estimated further cost to complete the project. We need to spend another 60 lakhs. Now, what about the total cost? 140. Okay. What about the contract price? If I complete the project, how much will I get? 150. Now, what about your profit and loss? How much can be recognized? How much can be recognized? Only 10, 5.71. Okay. Now I am going to rechange this. You can work out this way. Find out the percentage completion method. You got the value anyhow. Cost to date divided by total cost. How much is that? 57.1 percentage. 1.4 percentage. Number one. Then, what about the contract revenue? Okay, rest are this one. Okay, so we got the 5.71, no problem. This is the amount transferable to P&L account. Shiv Buildcon Limited obtained a contract to construct a bridge for rupees 50 lakhs. So contract price being 50 lakhs. Rupees in 1000 means 5000. Will be completed in 4 years. 4 years details given. Now, the company seeks your advice in presentation of accounts keeping in view of the requirement of AS number 7. Very simple illustration. Come and join with me to solve this illustration. How will you calculate the profit? Start with the contract price. Same format, okay? Contract price. How much? 5000 rupees. Then cost to date. How much you spent as on today? 800. What about the further estimated cost? Cost to complete, okay? Further cost. Estimated further cost. 2200. What about the total cost?
8,000.
Okay, what about the estimated profit?
4,000.
Tell me percentage of completion. How do you calculate? Cost to date divided by total cost. 800 by 3000. Okay. 26 point. Now transfer to P&L account. How much? On this estimated profit, you have to apply this for percentage. 533. 3. Transfer to P&L account to date, up to date. What is the amount transferred to P&L account in this current year? This is current year only then. Okay, so 533. This is current year value only. Clear? That's it. Very simple. Is over. Let's go for the year 2. Estimated profit being, 3800, estimated profit being 1200, still decreasing. Here, which is the loss got over, our contract price being 5000, total cost is spent being 4200. It is completely over. Completely over. What about the last one, sir? Progress payment. So from the contractee, whatever the amount is spent, no, now and then you start collect few money, few amount. Ask them to give some money. Okay, you are collecting. Is that okay? 5200 minus 4200. 800 will be the 800 will be the estimated profit. 800 will be the estimated profit. Now, what is the percentage of completion here in the third year? 78.95%. Then how much can be recognized? 1200 on that 78.95%. 947. Okay, 0.36. Already we recovered 900 recognized in the previous year. In this year, you can transfer only 47. In the last year, 100% completion, 800 rupees can be recognized, but you recognized 947 in the previous year. Now you have to de-recognize 147 by debiting. Okay. You have to debit this value. Debit to P&L account. Is that clear? This question is all about disclosure related. How do you disclose in your books? Okay, let's see. Now, A firm of contractors obtained a contract for construction of bridges across river Revati. The following details are available in the records kept for the year ended 31st March 2021. Total contract price 1000. Work certified for the cost incurred 500. Work not yet certified 105. Estimated further cost of completion being 495. Progress payment, everything is given. This is cost to date. This is to be incurred means for estimated further cost. Oh, this is also cost incurred. So these two are cost incurred. You need to get some certification before you claim the money from the contractor. So 500 rupees I spent and then I got certification and demanded the contractor to pay me. So I got the collection. After getting, still I spend another 105. So these two will be called as cost to date. 605. Estimated further cost 495. So total cost being 1100. Then definitely your loss being 100. Transfer to P&L account. How much? The entire 100 can be transferable. And progress payment. Now and then we will collect some money from the contractee. How can I construct without money received? Usually whatever the work certification you receive now, on that some amount you will be getting. 500 you got 400 and 140 like. The firm seeks your advice and assistance in the presentation of the accounting. Presentation of accounting. Okay. So other things are very easy. But how do you present in your books? Now, number one, for the foreseeable losses. Foreseeable losses. What's that? Contract price minus cost to date, estimated further cost 1100. So your loss being 100. This is how you can give the notes, disclosure below. For all the calculation, you need to give the notes. That's all about the presentation. Contract work in progress, you have to state separately. This includes what? Certified, not certified. Work certified, 500. Work uncertified, 105, 605. Third, you have to give percentage of completion separately. How do you calculate? Cost to date divided by total cost in percentage. Cost to date being 605, total cost 1100 in percentage, 55%. What about the contract revenue? Contract revenue. Okay. Contract revenue. Contract revenue is nothing but on overall 1000 rupees, 55% you are eligible. 550. That's what about the contract revenue. It's not contract profit, contract revenue. Out of 1000 rupees, currently you have completed 55%, no? So contract profit, contract price into percentage of completion. That's what about the contract revenue. If you are asked, then you have to answer. And what about the amount due to our customer? Okay. Now, what is the cost you incurred for this? 605 incurred. How many amount recovered? Okay, amount recovered from the contractee. 540. Balance. Okay. Now, amount recovered minus loss is your money, no. How much is the loss? 100 rupees. That you have to bear. In case of profit, you can add the profit. In case of loss, it should be subtracted. Then 35 rupees you have received more than the amount recoverable. So you are liable to contract. Okay. Contractee being my debtor. Sorry, my creditor. I am liable to him. I am liable to him to this extent. If I receive lesser than that may be asset. whether I have to pay or I have to recover. How much is the amount I spend? With that profit and loss added or subtracted minus amount recovered will be the amount either payable to the contractee or receivable. And what to disclose? Disclosure. Contract revenue should be disclosed. Contract expenses should be disclosed. Profit and loss should be disclosed. Here loss being 100, contract revenue we have calculated 550, contract expenses being how much? Currently 605. Okay, only this one you have to state. For that all the calculations are done as a working note and incorporate here. That's what about the disclosure topic here. Calculation of profit and loss is done and this loss is transferred from the P&L account. Transferred to P&L account. That's all. Rest will be for requirement of disclosure purpose. With that this illustration is also over. Now, see loss recognized fully. These are the theory we already studied. Reliably, if you are able to measure and amount also confident you have to collect, only then you can recognize this as your revenue. In case of fixed price contract, how can you recognize the revenue? Total contract revenue should be measured reliably. Economic benefits, the amount will be receivable. Contract cost and stage of completion should be known, and exclusive specific contract cost should also be identified. Only then you can recognize. We have recognized the revenue based on this approach only. In case of cost plus contract, it's very simple. Whatever the expenses is the headache of the contractee. Any expenses does, I collect another 10% extra. The amount collected is for me. Economic benefits will flow to the enterprises and attributable contract cost. If there is any small cost, then it can be identified. Okay. Then you can recognize easily. The other points here not required. And this one here. Okay. The work in progress being the asset. Work certification, work uncertification, both will be there. Stages of completion being calculated predominantly under cost method. This method we follow. It's not only method, we have other two methods also. Survey method. Survey method is nothing but we'll call an expert, architect. He will come and survey to what extent of the operation is completed. That is called survey method. Third one is completion of physical proportion method. Physical proportion. I need to construct 1000 square feet and currently 600 square feet is completed. Then what's the completion stage? 60%. So we have three methods to find out the stage of completions. Cost method, survey method, completion of physical proportion method. And already you have a contract to construct a building. Further, while constructing, the contractor demanded, sir, construct one more room over the top floor. Okay. The contract revenue for this, the contract price for this being 100 lakhs. As I demanded, he just added 10 lakhs separately. Now, if I approach to the new contractor to construct this, he demanded 25 lakhs. Why this fellow demanded only 10 lakhs? Already there is a business. He is just expanding. Okay, already relationship is there. I no need to get any profit, sir. I'll manage myself. Nominally charges. In this case, this fellow considers these two as single contract. No, sir, that is separate. This will I will calculate separately, including my profit. Then it will be considered as separate. That is what about. In case of additional contract or multiple contracts you will get, can I combine all these things as a single contract or segment this contract one or two like? Contract covers number of assets but treated as separate contract. Okay, when separate proposal having, see, I have to construct room number 1, room number 2, room number 3. I give the bill for this separately, bill for this separately, bill for this one separately, get the order closed for each and everything separately, then it is called separate contract. This will be called separate contract. Number 1. Now, a group of contracts with a single customer or not, maybe or not, treated as a single contract. This will be considered a separate contract. Here, single contract when all the group, this one, all the things put together negotiated for a common rate. So, if I get 110 lakhs, thereafter tell, sir, I don't want this. Sir, if it is cancelled, then you have to pay 105, sir. Sir, okay, I don't want this one. No, sir, if you want this one, I will charge 15 lakhs. So, separately the rate will be different. Collectively only has given. I can accept collectively only. I cannot cancel one of them. Then it is called single contract. Single contract. This is separate, this is single contract. Number 1 and number 2. And next one being change of scope of contract. Change of scope of contract is nothing but I construct a house property 10 by 15. While laying this wall, I ask him to make it 20 by 10. Then he has given the quotation only for this one. Now he demands additional money for this. Okay. So, new asset, see this is this one. Now, question is, can I consider this being contract number 1 and this will be contract number 2? Can it be? Definitely not so. It will not be so. Okay, depending upon what scenario. The new contract extension, new asset differs significantly in design, technology, function. Then it is a separate. Else it will be original contract extended. And the price of the new asset is also negotiated separately. So, if I demand to extend, this one is considered as a separate one and the extra price is charged only for this, exclusive for this. Then that will be called as separate contract. Else it's a combined contract. So, you have to understand what is called combined or segregated contract. Now, see, XYZ Construction Limited, a construction company, undertakes the construction of an industrial complex. It has a separate proposal raised for each unit to be constructed in the industrial complex. Since each unit is subject to separate negotiation, he is liable to identify the cost and revenues attributable to each unit. Everyone will be identified separately only. Should XYZ Limited treat construction of each unit as a separate construction contract or not? Yes, it is a separate only, not a combined one. Not a combined one, it's a separate. Clear? This statement not required. We have already solved the illustration, so this statement is not required. And what to disclose? The last illustration is all about disclosure only, no? Okay. What is your revenue? What method you follow? Retention money? All these details are given there. That's all. This illustration, this theory solved as an illustration in the third question. Is that clear? So that's all. With that, contract costing is over. Accounting for contract is over. See, we'll deal. How do I recognize the revenue? Revenue recognition. A is number 9. A is number 9. Requirement of revenue recognition. Revenue. The gross inflow of cash, not only in cash, may be receivable later on in case of credit, or other consideration from the ordinary activities, such as 3 aspects: sale of goods, rendering of services, revenue generated using the enterprise resources. For example, they have the fund maybe invested in the share market or invested in any other thing. So, where you will get either dividend or interest, or you allow your technical know-how to use by others for a royalty. So, dividend, interest, royalty, 3 aspects are also be covered. In case of receipts of dividend, interest, royalty, when can I recognize this being the asset? Okay, it's very simple. If you go to the shop, if you are purchasing the material, seller immediately recognizes that as his revenue. Is that okay? Very simple. If the goods supposed to be delivered at your place, revenue will be recognized only if it is delivered in your hand. It's delivered in your hand. Meanwhile, on transport, if anything lost, then owner is responsible, means the seller is responsible. Okay, seller and buyer, buyer comes to your place, picks the stock and goes with him. Then the sale happens here, amount is also paid, then can be recognized. If seller demands buyer demands seller to deliver here, okay, then sale happens here only. If the goods are lost in transit, in this case, if the goods lost here, who is responsible? In this case, B is responsible because sale is confirmed here. In this case, the goods lost here, who is responsible? Supplier is responsible. B says, sir, I asked you to deliver at my home. This is the one condition. Means the significant risk and reward of that commodity is transferred. Number one. Number two, cash should be received or receivable. Received, no problem. In case of receivable, there should be certainty of collectability. CC. Certainty of collectability should be certain. If there is any doubt, you shall not recognize that. Okay. Now, this A is number 9 not applicable for what? A is number 7 contract. We have separate one. A is number 12 grants. We have the separate one. Hire purchase we have A is number 19. Insurance contract also not applicable under A is number 9. This A is number 9 is not applicable for that. And items not included as a revenue, profit and loss on sale of PPE, okay, including revaluation gain. It is as part of PPE. A is number 10, not under A is number 9. It is not going to be considered revenue for a revenue calculation as per A is number 9. Unrealized holding, change in the value of current assets or natural increase in herds and agricultural and forest products. Natural increase. Okay. So those things will not be recognized here. For that, see, if you are growing poultry, year on year the weight of the poultry is increasing, means cattle may be increasing. The value increasing means the sale value also increasing. Can you recognize this being your revenue? No, you cannot recognize unless it is sold. So for that, A is number 9 will not be applicable. And foreign currency translation, we have separate one, not applicable here. Any unrealized gain from discharge or restatement of obligations, all these cases not falling under A is number 9. Only 3 cases. What are they? Goods, services, enterprise resources for generating interest, dividend and royalty. So in case of goods, sir, in case of goods, 3 conditions. Goods transferred, significant risk and reward also transferred, ownership, and collectability is guaranteed. No uncertainty for collectability of the consideration. If these 3 are confirmed, then it is your revenue. Only this. So in this, you have to understand these 3 points only. Rendering of service. Rendering of service. If it is being single act, small act, after completion, matter of 3 months or 1 month or 15 days, okay. On completion, you can recognize. If the contract goes for more than 7 months or 1 year, 2 years, proportionate completion. Like what the method we studied under ES number 7, no, that will be followed. Completed contract method or proportionate completion method. For example, installation of machinery, repair of services. Come and finish of the repair, take the paise, and the person, repairman, can collect the money as revenue only after the repair. But in case proportion completion, this will take around 6 months time. He demands, I need a charge of 6 lakhs rupees to complete this. In that 6 months, 4 months ends in the previous year, another 2 months for this period. Then how much you can recognize? Only to the extent of 4 months work what you have done. Under SLM method, you can recognize every month maybe 1 lakh. This is what about the recognition criteria for services. Another one being goods, services, another one being interest, dividend, royalty. Interest, time proportion based on the time per month basis. 3 months means 3 months interest. Dividend, declaration, right to receive. Once it is approved to pay, whether you received or not, you are guaranteeing to receive this, so it will be considered as your revenue on the date. Royalty, usually accrual base, or you go and refer the agreement between the lessor and lessee, how the term is there, that will be followed here. Hope you will be now able to understand this one. Now, In all the cases, recognize only no uncertainty of collectability. Okay. Any uncertainty raising the claim, postpone the revenue recognition. Any uncertainty after the claim. First one is claiming itself delaying. Next, we claimed recoverability is delaying. Then make a provision. Third one is revenue is not reasonably determinable. Postpone. In these scenarios, you can postpone. You claimed, thereafter you came to know that fellow is not going to pay. Then you can make a provision like bad debt. This is provision for doubtful debts. Like here, I have not raised the claim at all. Will I raise or not? Doubt is there. Don't recognize the revenue now. Okay. And in case of postponement, you have to disclose the reason also. That's all. So with that, all the aspects are over. Only three aspects. What are they? Goods, services, and enterprise resources for generating interest, dividend, and royalty. Right. We'll see the illustrations here. The board of directors decided on 31/3/2022 to increase the sale price of certain items retrospective from 1st January 22. In view of this price revision with effect from 1st January 22, the company has to receive 15 lakhs from its customer in respect of the sales made from this date to this date. Because of the revision, they have to get this much amount from the customer. Accountant cannot make up his mind whether include 15 lakhs or not for this period. Can we include or not? Certainty of collectability should be there. Okay. So it can be, if you are confirmed that this is recoverable, certainty of collectability is there, then you can recognize, you can consider as your revenue. Related to that period only, while selling, I told to the customer, sir, I will go for the revision. I gave the value only based on the estimation, sir. Final value I will tell you later. So I am telling the final value. Customer also accepted, we assume. Customer also accepted, he will definitely pay me money. There is no any doubt on recoverable amount, so I recognize that. Y Limited used certain resources. In return, Y Limited received 10 lakhs, 15 lakhs as interest and royalty. This is interest. Interest means in what ratio? Time. This being royalty. Royalty means accrual basis or terms of agreement. Terms of agreement. Okay, you are required to state whether and on what basis these revenues can be recognized. 3 and 4. 3 and 4. Claim lodged with the railways in March 2020 for a loss of goods rupees 2 lakhs had been passed for payment in March 2022 for 1.5 lakhs. Okay. So we lost, there is a loss 2 lakhs are. Then I recover 1 lakh 50. No entry was passed in the books of the company when the claim was lodged. Advice P and company. So while lodging, they have not passed entry. Yeah, while lodging, they are not sure whether the amount is recoverable or not. So certainty of collectability is a doubt. Or my claim admission also be doubt. So that they have not considered this being the revenue while raising the claim. Correct. On receipt, they confirm receiving only 1 lakh 50. Then you can recognize on receipt of this 1 lakh 50 as your revenue. So what they have done is correct. Okay. Not recognized in this date. Correct. Recognizing here is also correct. Now the question is it prior period item? No, sir, it is not prior period item. Right. Now, in the year 21-22, XYZ Limited supplied goods on consignment basis to ABC, a retail outlet. So, XYZ to ABC, both are same persons, right? Branch like. Okay, same person. As per the terms, ABC will only pay XYZ for the goods which are sold by them to the third party. Once the goods are sold to the third party, the amount will be payable. If it is not sold, it's going to be returned. It's like branch and consignments are same. Okay. Okay. Rest of the goods can be returned at any time. 10 lakhs worth of goods are transferred. During the year 21-22, ABC had sold 5 lakhs 50,000 rupees worth of goods. And the rest of the goods still laying, balance remains there itself, may be saleable or if it is not saleable, returned. Okay, advise XYZ how much revenue it can recognize. How much revenue can be recognized? Only the sale happened at your consignee point, not the sale you have done. Because in that case, you may have the returning dates also. You can get returned. So you can recognize only the sale happens in the hands of the consignee, not in the hands of the consignor. You sold, that fellow at any time may return if it is unfit for sale. So that is not guaranteed. This value is not guaranteed sale. This is guaranteed sale. So only this will be recognized as your revenue.